Welcome back. Joining us on the show now is David Lennox, analyst at Fat Profits. David, hi, good to have you. And this has started as a data-heavy week. We have inflation numbers expected out of China and US. And the first set of data that came in today, which is the China trade data, has clearly been disappointing. The export and import numbers much lower, double-digit lower for the month of July. How are you reading it and the kind of impact that it has had on metals as a sector?
Look, certainly if you have a look at China as a whole, the market's been well aware that that country's economy has been struggling for some time now. The opening COVID dream disappeared out the door fairly quickly as we saw economic data pointing to slower growth. However, we are now well aware that Chinese authorities are acting to try and stimulate their economy. They're trying to ensure that there is some form of stable growth going on. They have got a target of around 5% GDP growth that they did indicate to the world that that's what they were looking to achieve. And we think that at this point in time, that's what they're trying to do. So if we are right and the authorities are looking for that 5% growth target, then one would suspect that some of the data that we've seen will start to point more firmly to a slightly better outlook for China. And that's going to bode quite well for commodity prices. However, with a growing economy, we've got the possibility for inflation to re-establish itself. So we'll be watching very closely on that front. And of course, we know what happens with that. We see interest rates being slammed on and the opposite happens. So at this point in time, the markets are probably a little bit concerned about which way the Chinese market may go. But we're leaning towards certainly China pulling the stimulatory levers and starting to chug a little bit faster than it is at the moment.
David, how would you read the recent stimulus measures that China has taken, focused for various sectors? I mean, that really hasn't had too much of impact, has it?
Look, at this stage, you'd have to suggest that no. And yes, those stimulatory measures had to be focused because if you have a look at their property sector, which is where they threw money at last time the economy was in trouble, is itself still somewhat laggard. So one would suspect that throwing any stimulatory activity at that particular sector would do no good. What we have seen is that, yes, they've selectively gone out and changed, especially credit ratings and credit risks to industry. And that's allowed those industries to perhaps expand a little faster than they would have. Yes, that's not such a big consumer of commodities as perhaps the property sector would have been or infrastructure, but certainly it would be enough to, the supply of goods going into those factories and coming out would certainly be enough to keep the commodity cycle going. And really at this point in time, that's the key factor, keep that commodity cycle moving along nicely. And when we do see China start to improve more strongly, we'll see firmer demand coming out of China.
So, David, what's your sense going forward from here? What kind of a strategy would you deploy when you're trading metals as a sector?
Look, at this point in time, we've been fairly long in nickel and copper, and we really haven't changed that strategy for some time. We've been fairly long in lithium. We haven't changed that strategy as well, and also iron ore, where we believe that China will of course in due start to really stimulate its infrastructure sector, and that will benefit iron ore. But at this point in time, we've remained quite long across the three commodities that I've mentioned, and certainly we will continue to play in the base metals sector in those two commodities, in copper and nickel, and we'll continue to have a presence in lithium.
Okay. All right. Thanks a lot, David, for joining in, and Manisha for breaking that down for us as well. With that, we'll take a short break, come back, get you more on the markets and individual stocks. Stay tuned.